Perfect. Okay, Anders, welcome. Can you give yourself a little introduction, what you're doing before Debite, what Debite does? And yeah, let's start there.
Great. Well, hi, everyone. It's great to see everyone here. Thanks so much for inviting me. I also see some Debite customers, or at least in the company tags there. So hopefully they can provide good feedback, positive or negative, on ways that we can improve. Just a little bit about myself. My name's Korin. I'm CFO and co-founder of Debite. Before my, adventures in startup world, I was in investment banking, doing specifically credit risk management at JP Morgan, focusing on early stage companies. And I was there for about 12 years, but I think 7 of those years I was content, and then the last 5 years I wasn't. So I started putting wheels into motion to launch my own my own startup, which wasn't Debite at that time. It was a consumer-facing fintech, all around helping parents manage the cost of having kids. An issue that I felt very personal in my own household. And so I launched that, spent a lot of time really thinking through that business and launching it with all the hope and excitement that a first-time entrepreneur has. And then COVID hit, which was a bit unfortunate. And we ended up growing that business to about 20,000 users, but we just couldn't raise enough money to take it to the next level. But then when winding that business down, Taiga, my co-founder and CEO at Debite, reached out to me with this broad idea for B2B financing. And it was something that I definitely saw from the problem that traditional financial institutions don't understand this early stage space was something that I saw from the lender's perspective at JP Morgan and from my own startup experience. So I felt like it was definitely something worthwhile to address. And so I jumped into Debite. And what Debite does, so we launched we're an early stage company ourselves. We raised pre-seed money early 2022. And then we launched our product in summer 2022. So we've only been around for about 7 months or so. And what Debite is, it's a flexible credit card that is especially designed for startups and early and small businesses. So its flexibility really comes in 2 features. One is that there's a built-in buy now, pay later installment options that allow you to spread large costs over a period of up to 12 months. And then second, it offers the ability to use your credit limit to make bank-to-bank payments. So this is particularly useful for suppliers or merchants that don't accept credit cards. You can make payments.
So I know even though it's a young company, you guys have grown really fast. So my first question is, how did you allocate your pre-seed round to grow that fast? But also, what lessons did you have from before with the company that you were working on previously? How did you spend money after you raised that round for that prior company? And then how did it change between that company and Debite?
Well, there's no better education than doing it first and making tons of mistakes. So I have countless best practices with the first startup. Actually, both sides of the spectrum of not spending enough in some areas and spending like way too much in other areas that frankly didn't matter. So I think one thing that I found in that first experience was that I was so focused on closing the round, on getting the money, that I really neglected, once you get the money, what is your day one? What is that? What are you going to focus on day one post closing? And closing around is great, but it's really when the quote unquote real work starts. I find that many founders are understandably so focused on getting that money that they treat it as an end rather than a beginning. And so it takes time to get the traction that you need to to raise the next round. So there's really no time to waste. So for us, during that time, we were already really thinking strategically and tactically about that launch in the summertime. So even before the pre-seed money came in, we spent a lot of time in terms of how are we going to get those first 10 to 20 customers, for instance? What does that look like in terms of time, in terms of resources, both in terms of people as well as money. So when the money came in, we kind of knew exactly what to do, and we didn't just go crazy spending on all the wrong things, which frankly I did in the first time around. And I find that so that discipline, you kind of know that discipline's important, but that you're being pressured on so many different areas that it's actually really, and pulled in so many different directions, that it's hard to maintain that discipline. So what I've learned from this experience is really almost thinking of it in terms of these kind of monthly investor updates. It kind of focuses you on or forces you to focus on what matter. What are you going to tell in that after that first month in that investor update? What are you going to focus on? And for us, it was all about that launch. So we knew that what we needed to spend on was all about that launch.
So it sounds like the main thing is understanding what the correct thing to focus on is, but how do you balance that with potential new opportunities that might come up? Like, let's say you're deciding you're going to spend 40% of your pre-seed money on marketing. That's just an example. That's probably not what people want to do, but just go with that example. So at the 40%, you're spending half on, let's say, like Instagram ads and half on, I don't know, in-person campaigns or whatever. How do you understand, like, if something new comes along, should you reallocate your budget? And when is the correct time to do that?
Yeah, I mean, that's always going to be a tension. There's always trade-offs. But it's important to realize that every decision you make for your company is a financial decision. Whether it's sooner or later, it eventually becomes a financial decision, has a financial impact. And just like people's time in any source of, or in terms of however you define resource, whether it's money or time, there's always going to be a trade-off there. And what I find is that there's this interplay between strategy and spending that runs between rounds. So for instance, like after a round closes, it's a time when strategy will dictate spending. You got the money, now let's just start executing based off of all the things that we want to do. But the closer you get to the next round, but before the next round, spending starts dictating strategy, because you're like, well, actually, I want to do all these things, but my cash is getting low and I don't really know what to do. Let's see what options we have now based off of our cash balance rather than the other way around. So I think by thinking about strategy more proactively, not just in terms of now, but later on, you can really be more consistent and be more meaningful in your decisions rather than, or proactive in your decisions rather than reactive in your decisions.
That's really useful. How have you balanced spending on growth or versus engagement? And like, how do you look at that as a founder? And also, as you're raising your seed now, do you find that investors are caring more about growth versus engagement? So that's like 50 questions right in there.
No worries. I'll have 50 answers just for that one thing. It's an incredibly interesting question, or difficult question to answer. I'm sure you all do this too, right? Because I do this. You look on LinkedIn, you looked at Twitter, and there's all these investors, really like high-profile investors or high-profile founders that have 1,000,001 advice of what you should and shouldn't do, and they're completely contradictory to each other, right? So like the lesson here is that you can do all those things, right? There's infinite good things and infinite bad things that you could possibly do. So now, with that in mind, how I look at this pre-seed and seed space is that I personally, to get to seed, you need to focus on customer love or product market fit, whatever you want to call that thing. And and it's better if it's monetized product market fit, not just people come and use it, but either they spend with their time or they spend with their money in terms of your product. I think that matters much more in this time than customer growth. Now, of course, you need growth to show that you're bringing customers in, and you need to fuel that, whether it be the marketing funnel, or you need to fuel, like, actually get customers in. Fine. There's a minimum threshold of growth that you need to maintain, but growth metrics are misleading in this space. Like, oh, I'm growing 100%, but it's from such a low base that you're quickly called out on that. So really what you want to show at this time is that, our customers, we have few customers, but they love us. And let me tell you all the ways, all the new learning we learned about how they love us. Now, a lot of our own product has been influenced by that. Specifically, that second feature that I mentioned in terms of using your credit line to pay, to make bank-to-bank transfer payments, that came from a customer. So we're like, actually, that's a great idea. Let's build it. Like, listening to the customer and having that kind of product market fit cycle is so important, and doubling down your spending. And when I say spending, I mean, again, spending all your resources, time, and cost and all that on what matters. So yeah, focus on marketing to feed the funnel, hire the people that you need to hire to prove that customer love. But if you don't, and why this is so important at this time is that if you don't find at least early signs of product market fit at the seed stage, then you'll never scale. It becomes way too expensive to scale, because you're basically pouring money into a funnel that has tons of holes in it, because either you haven't tested the marketing funnel, or people come in and then they churn out immediately away because there's no product market fit, or you don't monetize. So those are things that you need to prove early to make sure that the ship is watertight. And then you can start going. I'm mixing my metaphors here, but yeah, so really finding that product market fit is important over growth.
This might be getting a little granular, but when you're trying to decide how to spend that, like, let's say, 150K or 300, and now 250K with the increased SEIS limit, and let's say you have two options, like one is hiring a product designer, one is bringing in a new UX designer to try to make the product more engaging. So you have kind of like two different options that you think are going to increase engagement and customer satisfaction. Do you have any questions that you ask yourself to help you figure out which is the better one to allocate your capital and time to?
So how I look at decisions is that, well, kind of two things. One is that I think of decisions as, or when you think about kind of ROI and that kind of those kinds of concepts, that experimentation is key. That for us, we kind of treated everything as a scientific experiment. Like, you have the hypothesis, the observations, the conclusions to really evaluate what works and didn't. And you can take these lots of little bets that work really well. So rather than, for instance, going out and hiring a full-time designer or UX or whatever, you can hire someone for one specific project and test it. Whether, let's say, it's the landing page. Let's see if this landing page is the way to go, or this kind of design is the way to go. Do that, see again, have a hypothesis. We think that this will lead to this outcome. The observations happen. The conclusion was it did or it didn't. And we think, okay, maybe if it did, then at a bigger scale, it can achieve a different or a bigger result. Those kinds of rather than taking big steps, you can usually break it down into smaller hypotheses, testing different assumptions along the way. And that's usually what we try to do. That said, so small bets are great, and that should be the kind of standard practice, but you shouldn't necessarily shy away from bigger investments. Now, now this sounds completely contradictory because it is, frankly. But what I mean by this was, and I'll give you an example from Debite. So we were one of the major sponsors of the Sifted conference, right? We're like, it was us, Morgan Stanley, and Silicon Valley Bank, right? We're a pre-seed company, and we're one of these like names. That sounds outrageous for a pre-seed stage, a pre-seed company. But what we saw was actually for the financial investment, it achieved multiple purposes for us. It got us front and center in terms of our customers, our partners, our investors. We were able to have so many conversations and touch points than we would have anyway, and it actually worked out really well for us. But it could have equally not have done so. But why we made that decision was that even if it was achieving so many different levels, or different, achieving different, like hitting on so many different purposes, that if it failed on one or underperformed on another, we felt that overall it still would have been worth it. And it turned out it was.
And you guys threw a terrific after party at Sifted too, so well done.
That's all part of the investment.
Money well spent.
Yeah.
What how much variance was there for you between what you presented to investors on the pitch deck, okay, this is how I'm going to spend the pre-seed money, versus what actually ended up happening? And do you find that investors really care that much, when you approach them again for seed money, and that those percentages may have changed a bit?
I mean, no. Broadly speaking, if you're saying, I think they look at it and they say, okay, 70% is going to go towards hiring. Okay, like that makes it, that is your plan. I'm building out. So the plan here is, or the headline is, with this money, I'm building out my team. That's the kind of thing. So the gist is just what they kind of want to do. Whereas, so if an investor saw 70% going towards hiring, and the investor update says, hey, we spent all this money on performance marketing, but the story that I told you fundraising was that we were going to build partnerships or something like that and do it kind of cheaper than just paying Facebook for marketing, you might get some questions. But I don't think that investors are that, they're not auditors, they're just, They want you to get on with it, but they do want updates. So, however you're spending the money, whether it was in line with plan or not, they kind of want to know, not necessarily what you're spending on. They want to know what you're doing, like what outcomes or outputs there are. I think they're much more outcome oriented than input oriented.
Okay. I want to dive into investor updates quickly, but I'm going to remind everyone we'll move to audience Q&A shortly. And so make sure to put your questions in the Zoom chat or raise your hand and you can ask the question live. Okay, so going back to investor updates, how often do you send them? What do you include in them? Do you put potential investors that you're interested in speaking to on those updates? And actually, okay, I'll stop there. I keep overboarding with questions.
No worries. So we try to do it every month. It sometimes slips, but that's okay. I think if you just go into it thinking monthly, it's better than not. So usually you kind of give an update. So the typical investor updates are short. You don't want to kind of read through paragraphs and paragraphs of text. So bullet points are definitely your friends. Even icons or emoticons or whatever you have, emojis. Because the investors are probably receiving tons of them, and they just want the headline of everything's going great, or this is what I need help with. So the first thing is, okay, what's happening in your business? The second bit is all around just what comes next. So like, what are you excited about? And then the last bit is really around favors. We're looking to raise our next round. Do you have any investors, or do you have any advisors, or we're looking for a UX designer? Do you have any recommendations? I think that's kind of just on a steady basis, that's probably best.
And what ways or tips do you have for founders who have to communicate bad news? And let's say it's like bad news for the third month in a row, like usage is down, engagement's down.
Yeah, so luckily we haven't had to have that conversation with Debite, but I definitely had to have that conversation with StoreCard, my previous fintech, because ultimately we had to wind that down. And that was, so we just had some angels and some friends and family money in that. So there's no institutional money in that. But right when I started kind of getting a bit worried about the state of the startup, I started telling them, just being a bit more honest, that, we're not asking them for advice. I did this on a one-on-one basis because just there were lower numbers, so I didn't kind of treat it as everyone as a group. But I said, listen, I'm finding that in that particular case, what I found was that in my initial pitch to an investor, they would get excited about the topic, but then inevitably it went to IC, and then they said no. Like, it never went to the next thing. And I knew that I had a problem in my pitch, in the sense that because I was telling it, the excitement that I was telling it was catching on to the person that I was telling it to, but the excitement of that story wasn't carried on in the next chain of the telephone. The investor whom I spoke with wasn't able to convey that excitement of the idea to the person that they were speaking with. And I was trying to figure out, like, just something wasn't clicking. And what advice do you have on this? I asked my investors, like, how do you talk about StoreCard with your partners? Like, tell me how this conversation goes elsewhere. So they knew things weren't really working, and that we did a lot of research or a lot of work in trying to identify exactly the things that were working. So those conversations, continued, that it finally got to the point where they knew that it wasn't going right. I think people just don't want to be surprised. Take them on that journey. They know things won't work out perfectly, and you'll maybe have to pivot or not, but they just want to know that you're actually, on the level with them.
That makes sense. So try to reach out and have discussions around what's actually going on, rather than just like send an update saying this is down for the third, this is down for the third month, the fourth month, like kind of bring them in.
Exactly. And you will be, the problem is that the issue is that you're way too close to this, right? So actually they can provide a little bit of perspective, even if they're not experts on a particular subject, but they could just come on with have you thought of this or that? So it's incredibly helpful, not just to manage expectations, but also just in terms of your thinking. It's really helpful.
That makes sense. So talking a little bit about runway, what tips do you have for founders who need to extend their runway? What's like the best way to maximize it, especially as it seems like people are going to be going a bit longer between rounds in the current market?
So in terms of your runway, I don't want to overcomplicate finance. People that maybe don't have a finance background might just kind of think it's too complicated, but frankly it's not. It's not at this early stage. Really, it's increasing you can increase runway by doing two things: increasing the money in and decreasing the money out, right? So in terms of increasing the money in, it's all around equity funding. You're looking for SEIS, EIS, government grants, if possible, R&D tax credits, revenue, which is like, obviously, that's great if you can get revenue. And then even in the alternative financing market, is a growing field. Debite obviously plays into that. But if there's a bank probably will not give you a loan just based off of your limited track record, and if you're unprofitable and maybe you don't have tangible assets. But there are different alternative financing products that you can use. So Debite and other buy now, pay later credit lines are available to earlier stage companies. If you're a B2B company with maybe you're a B2B company and you have credit-worthy customers yourselves, but they take a long time to get paid, maybe invoice financing is for you. E-commerce companies and direct-to-consumer companies might look to revenue-based financing or merchant cash advances, perhaps. But just take a look. When you look at these, though, it's really hard to compare it apples to apples, because some are charged on a transaction fee, some are charged on a monthly interest, some say, an APR, an annual interest. So it's really hard to evaluate it. So just look at the overall cost. So not just the pricing, but also how much time it takes to get the financing, and also how much personal risk you have, because some of them ask for a personal guarantee. Not all of them, but some of them do. So the debt financing is really a promising place, and it's growing. There's going to be a lot more options there, but it's hard to actually navigate that landscape. In terms of the decreasing the money out side of things, I think you really just try to optimize those decisions for your business decisions with those small bets. So if you make the wrong decisions, at least you're not losing a lot. Prioritize cost in accordance with whatever metric whatever metric that matters at that time. And a financial model is key, honestly. It's having something that you can update every single month, that's easy to update. It doesn't have to be so complicated, but just understanding what your cash burn is and being able to change different scenarios is so important. So if you feel that you don't have that skill set yourself, there's what's called fractional CFOs that you can look towards, that you can basically hire like a day a month that will help you maintain those things. It's really, really useful to have that skill set, even if not in-house, at least on a kind of transactional basis.
That was actually going to be my next question on how you manage your burn. But I'll just say right now for founders, if anyone's interested in getting a fractional CFO, we hired a part-time FD a few months ago, and it's been like so transformational and gives us like so much time back. And he's really, really affordable. So we're happy to share contact with anyone if it's helpful. So can you talk to us a little bit about the tools you use to track your burn? Is there any software that you found useful, or with your background, do you already know how to do it?
Yeah, I think so we built our own dashboard for this, and we're kind of running things off spreadsheets and stuff like that. And why we've done that, only because we have that expertise in-house, but also existing platforms are great and they have a lot of promise, but they're generally designed for larger startups. Series B and above, that is all about keeping the ship stable, that maybe you have a lot of employees and you have to manage different corporate cards and all those other stuff. But in the pre-seed space, things happen, things change all the time. So you need to be able to, ability to chop and change things around. So could it be helpful? Maybe, but I think it would be cost prohibitive in terms of like the subscription fees that you would have. But yeah, so just having that financial model is key, because frankly, if you don't control your cash will control you.
That's it. We're totally going to take that soundbite and put it on our Twitter feed from a coffee discussion. Perfect.
Great.
Okay, last question for me before we go into Q&A from our members. I know this won't be applicable for everyone, but I think there's a fair number of people who will find it quite relevant. Since you're in the financial space and there's a lot of like regulatory oversight for you, how did you communicate that to investors? Because we know investors are a bit more hesitant when it comes to like financial oversight. Anyone who's like a fintech or a prop tech startup or health tech can probably relate to this.
So like, how did you ease them or convince them?
Did they have any like additional questions that you had to answer or prove?
Yeah, so for us, obviously, financial services generally are regulated on multiple fronts. Now, because we're focusing on limited companies, there's actually a lot less. Actually, lending to limited companies is not regulated in the UK. So it's surprisingly, it's not to the same extent as individuals, because basically businesses are considered kind of sophisticated borrowers. And ultimately, you're not going to take over someone's house. It's limited at the shares of the company. But if you're in the consumer space, there's tons of restrictions on that. So I think the most direct answer to this is make sure that you target the right investors, because investors that focus on fintech will know this already, or health tech. They'll kind of already know this and be comfortable with that concept. Don't try to win over someone that doesn't know about regulation but is concerned about regulation by telling them that, oh, we have it covered, because it's too much uncertainty on their front. That said, at least I don't know how it is in the health tech or other regulated industries, but at least in financial services, there are a lot of partners that you can use to get to market quicker without actually going through the regulatory hurdles. So, for instance, if you have a product like a product that has an e-money component, like a digital wallet component, you can go through a company like Modular or Railstar, that you go under their umbrella, their regulatory umbrella, and maybe it's 2 months of compliance audit with the company, but you don't need to go through the FCA, and you're still cleared. It just allows you to get through regulation a lot quicker. So there might be those kinds of shortcuts around it, but really target the right investors, and I think it works itself out.
Okay, great. Okay, we're going to move on to questions from our founders. I'm going to take a question from Ajit, which is in the chat first. But then Sanjay, I see a question in the chat. I'm a little confused by it. So if you want to come on and ask it live, I'll call on you next. Okay, so the question from Ajit is, with a small number of users to start with, even if there is good engagement, how do you grab an investor's attention in the first place, especially in a B2C space?
So B2C space is a bit different than B2B. So in terms of that growth, what I mentioned before in terms of growth, probably my comment was a bit more in terms of the B2B space, where you kind of have fewer but larger customers than the consumer space. So growth is a little bit more important on the consumer side of things, just because it's kind of there's a lot more consumers, and that is a bigger driver of the success of a product. I think my overall comment about engagement still stands, at least in this early space. But in terms of, sorry, could you just remind, now I went off into a direction, I forgot what so in terms of investors, about engagement and growth. So I think you need to, depending on the kind of product it is, you need to kind of decide what is the right number for to achieve those lessons. So you can look at what I did actually. My old company was, okay, my target market is X number of people. So what's the minimum number that I need to do to have at least a statistically significant sample size to achieve learning? So let's say that's, I don't know, 400 people, based off 400 people for the million people. I don't know what that is, but let's say it's 400. So you optimize to get to that 400 level of customers that are using your product, and then show them based off of the engagement of that. So you need to just decide, based off of sample size or based off of total addressable market, your initial TAM, what is that statistically significant amount, and then really focus on engagement. But so just on engagement, and this may answer or address some other questions. one thing that I I kind of thought previously was that metrics and transaction and traction can kind of win investors over, but really it's only one component of the overall story that you have. You need to think of your fundraising story. So this is the thing of why, the why, the what, the how of what your business is all about, and how that changes with each round. So let me just give you an example of with Debite, that like every round is almost a chapter in this fundraising story. So like, and the metrics that you focus on need to relate to that specific chapter. So for us, the pre-seed chapter was like all about this vision and how we're the team to do it. So the metrics that matter were all about the research and the early customer engagement that we had. Next, it was like seed is right now all about turning this idea into a product, that showing how customers love the, all the aspects of our product and how customers are borrowing and paying back. The metrics that matter here is really around engagement and customer love and product market fit. And then the next chapter is going to be our Series A, where we turn our product into a commercial enterprise. So how we found really great ways to tap into founder communities, small businesses, and it gives us that unique advantage in a competitive market, and how we're able to monetize effectively and customers are staying with us, et cetera. So it's all about acquisition, revenue generation, and retention. And then later in Series B and above, it's all about turning that commercial enterprise into an established business. So expanding into other markets or other cross-selling other products. So it's all about growth, growth, growth. So you really kind of need to think about what what is that story that you're telling investors, and how can I make that exciting, that story exciting, by weaving in the metrics of my business rather than having your pitch as metric first, right? You need to get people excited, and you need to have that excitement carry through the game of telephone that they have ultimately to get to a decision. So understanding how that story carries is really important. And that was a lesson definitely from my first startup.
So equal parts narrative and metrics, kind of no matter what round you are, even beyond pre-seed. Okay.
Yeah.
Sanjay, do you want to ask your question live? I saw you have 2 questions in the chat. So
yeah, sorry if it wasn't very clear the way I wrote it, but we've spoken a lot about once you get the money, but I think it's also very important to talk about what was the process that you went through in terms of identifying the investor that you thought would be the best for your project. How did you go about targeting the investors? And secondly, how do you go about developing the rapport of trust between you and the investor? Because, you onboard an investor for a long time, and they become really part of your business and part of your personal adventure. So how do you make sure that they're a right fit? And what pitfalls are there to avoid when identifying an investor before you even start discussing financials and figures, and before sending them their pitch deck? And thank you very much for your insights, by the way. I found them very interesting, because here in France, because I'm based in Paris, the situation's a little different. So it's always very interesting to see how in the entrepreneurial world things differ from country to country. So thank you very much, Andres, for your—
Yeah, no worries. Thanks for that. And I did write the questions here, so I remember them. So there's a general partner at YC called Dalton Caldwell, and he has this video on how to create luck, and it's all built around how, if you haven't seen it, it's really great. And it's all about how, you can't control luckiness per se, but you can really find, you can increase the chances of you being lucky. With every email you send, every event you attend, every test you do, you can definitely increase it. So doing all those things to really increase that, and that works for everything, but it works especially with fundraising, because luck is definitely part of it. Finding the right investors definitely part of it. And frankly, it's like dating, you find a lot of just a lot of no's before you get to yes. So just finding those opportunities, an investor is not going to come to you, you're going to go to an investor usually. So just getting yourself out there, looking at things like Crunchbase or other companies that not direct competitors, but like maybe similar companies. You can look at their investors. You can also reach out to those founders as well, and maybe build a relation. Oh, I love what you're building with this. Build a rapport with them, and ask for an introduction as well. So that leads into the second question around trust. So people will trust you because they were introduced to you by someone they trust. So bringing in one investor and then having that investor introduce you to other investors, that's a good means. Going through your own personal network to make those introductions is really trust by association. Trust, I think many thoughts about what I'm about to say, but like signaling in terms of where you went to school, what CV you have is also honestly in this day and age is still a signaling device in terms of trust. And then ultimately just being accountable for what you're doing. So in terms of investor updates, like that's really important. So including potential investors, maybe someone that you had a conversation with that said, oh, keep me updated. Keeping them updated, like send them part of that investor update that you're sending to other investors. Like, why not? That just shows that, oh, we talked about it and I'm following up on what you said. Or if they say, hey, I should introduce you to so-and-so, even if you think like, oh God, there's like, this person's not going to be helpful at all. Just at least having a 30-minute conversation with this person, at least just you build that reputation as someone that does as he or she says that they'll do. And then finally, the pitfalls of if an investor wants to invest, they will. You chasing them up, if they go cold, you know what, move on. Just like maybe you keep them on the investor update thing, but I spent way too much time in my previous startup, and honestly, even in this startup, chasing up these dead cold leads leads that just went completely cold. And investors are, honestly, I don't know what they do all day, because they say that they're like founder focused and they're all doing all this outreach, and you're like, well, I just spent an hour or two with you. Like, at least you could do is just say, no, it's not for me, right? But honestly, I don't know what they do. But just don't let them suck any more of the resources that you have. Because again, your time is the most important thing right now. It's your most important resource. So they are literally taking money out of your pocket when you send them all those emails. So don't let them.
It's on mute. I saw a lot of people smiling and nodding when you said that. Okay, we have a lot of questions to get through. So are you cool if we do 12 minutes of rapid fire questions?
Sure.
Okay, great. Laura, question from Laura. What format do you prefer to send monthly investor updates in, i.e. typed in email body, or do you prefer to create a deck or use Substack?
Whatever's quicker for you. Honestly.
Okay. Next question, Francisco. Any thoughts on raising bits and bobs, meaning across a period of time? So agile funding versus a proper price round. What are the pros and cons?
Agile funding is absolutely better than a priced round, especially at this stage. There's so much uncertainty, and that uncertainty breeds lower valuations and more dilution for you. So always invest and negotiate at a position of strength, which means having money in the bank. So agile funding, convertibles are definitely the way to go.
Great. Any thoughts on going for growth first and then trying to monetize it later?
So that's frankly an outdated model right now. That could work, but it worked at a time that there was a lot of money out there, and there's less money out there, or there's money out there, it's just a lot of scrutiny in terms of how people are spending it. So the build it and they will come, or build it and they will pay model is something that frankly my old startup was built around, and frankly with COVID the bottom just fell out from that and the landscape just changed.
I have a question from Ewan. As you raised a fair chunk of change at your pre-seed, did you say or do anything out of the box that made you stand out?
So the fair chunk of change, so we actually raised like a chunk of that was debt as well. So debt from a shareholder for us to lend to our customers. So the number might be a bit bigger than expected, but I don't think we did anything. We had the benefit of my co-founder and CEO. He had previously exited other startup, had those relationships already. So that really helped us in our example.
Okay. Question from Solomon. Oh, no, that was not a question. Okay, question from Tim. To what degree do you lean into spending existing resources towards generating the results like MRR, user numbers, other traction, that you expect your target seed investors will want to see versus investing in longer term value creation?
So when I think of it as, again, it's the metrics are the illustrations in the story that you're telling. So don't necessarily think about the investor, because as we saw, like I said in the beginning, you see on Twitter and LinkedIn, investors have tons of different information, but they're also like, no one knows this business better than you do, right? So like, how are you telling this business? How are you telling the story of this business? So really be focused less on the metrics that they think are important, and more focused on the metrics that you think are important, because it proves this story and it makes it exciting for people. Then it's just a matter of telling that exciting story and finding the person that gets really excited by that story rather than the other way around.
Okay, question from Rahul. You've touched on this a bit. What stage was your company at when you closed your pre-seed round? And then I think you mentioned that you were pre-launch, so if there's anything you want to add around that. But then I'll also add to his question, what stage are you at now that you're gearing up for a larger seed round?
So we were pre-launch, but we had most of the core team already locked up, because a lot of it came from my co-founder's previous company. They joined this company as well. So we weren't looking to kind of expand the team or anything. So it was good in that sense that we could just really focus on, okay, now we have the resources we need. We just need the money to implement exactly what we want to do for this launch. In terms of now, what we have now is we have about 70 active customers on our platform, a bunch of people on our waiting list right now, and we're looking to close this seed round so that we can start onboarding this waiting list that we have, this kind of backlog of waiting lists. Because for us, we need to raise both equity as well as debt to on lend to our customers. So that's the kind of challenge here. But already we're seeing signs of product market fit. We're seeing ways to monetize. We're seeing increased appetite for other products. So that's the kind of story that we're telling in this seed round, that we have evidence of customer love. Let us show you how this is and how we're becoming a core part of their finance stack. And then this is the promise. With this money, we're really going to, make our presence known, be the provider in this segment of the market in the UK.
Okay. Question from Daniel. What's the best way to find early stage investors?
Honestly, if you go so early stage institutional investors, Crunchbase, you can filter according to UK, according to sector, according to investment type, and it will give you a list, a printout of thousands of companies. That might be the pro or the paid for subscription. In terms of angels, really going through a lot of angel networks and applying there, or even events. those kind of pitch sessions. Pitch sessions are always good because it helps you practice your pitch. You're probably not going to find an investor there. You might in the audience, but generally the people that attend pitches are the people that are selling to startups, which is incredibly frustrating, but it is what it is. But just again, finding those opportunities to be lucky is what it's all about.
We'll send out some databases that we know of as well too.
And
Okay.
I should say, by the way, like being part of this accelerator that you are part of is like already a great step in that direction, because you want to find every decision you make, you want it to have a multiplier effect. So your decision to join the accelerator has this multiplier effect because suddenly their network is your network.
Absolutely. Okay, question from Mark Robinson. So for founders who do not have your lengthy financial background, what advice do you have if you're starting a financial model from scratch?
Yeah. So what you think of it so accounting gets kind of complicated because you kind of have something called accrual accounting and cash accounting. Like forget about the accrual stuff. Think of everything in terms of cash. So money in is just the revenue. Then you have just all your different costs, like operating costs, and then you have the profit here. And then you just create that basically. Revenue and cost here will give you a sense of on a month-by-month basis how much your and I guess you could have here just in terms of other money coming in, so from equity or grants or whatever, what have you. And then you basically just have, so you can see how much you're burning each month, and then you start with a cash balance so that you can see when your actual cash will run out in what month. Like even just a basic model like that, then you can start making it more complicated by saying actually the revenue line is fed by a separate tab. Then you can add more products, you can make different assumptions around the revenue, or your payroll line is another tab, and that's fed through what your hiring assumptions are, or same with marketing. So you can kind of almost create every single line links to a different tab, so for you to get kind of more in depth. But really what you just need is that first one. And honestly, 2 years, you don't need to go crazy, just the next 2 years, a rolling 24-month basis. If investors ask for more, they're the wrong investors. They're like late stage.
Okay, 2 quick things to try to touch on in the last 3 minutes that we have you for. So the first question is, what's been the hardest question that you have been asked by investors? And secondly, tell us more about how founders can take advantage of Debite.
So hardest question that I had. So for this specific product, so for Debite, we are, we service early stage companies, and the reality is that, and we're lending to early stage companies, and the reality is that a lot of them will go bust. That's just how it is. So the questions that we have around, and I think we now have good answers, but like, how do we manage? So we have answers around how we manage that churn and how we don't lose a lot of money when those things happen. But the more difficult question is actually, how do you manage the customer experience during that time? So recognizing that things could go wrong, but you don't want to, the founder's doing all that they can during that time, but you don't want to pull the rug out from underneath them at that time. So really kind of managing, protecting your book, but at the same time, really trying to be there for the founder is honestly something that we're still trying to figure out ourselves. In terms of how, so debite.io is our website. You can sign up. Again, we have a waiting list right now that we're slowly onboarding, but we're going to close our seed round soon or shortly, and then we're going to onboard a lot of customers. And actually through Hotbed, we prioritize that, so you can go to the top of the waiting list. And not all customers will get the big limit, and not all customers will get the 12-month kind of installment. But what we really want to do is be that first corporate credit card for you and grow with you. So really, we tap in through open banking to your account. So we could see, and this has happened with some of our customers, that the moment the money comes in, boom, the credit limit is automatically increased, and you have a longer tenor as well. So we really want to have that seamless experience for the customers and really grow alongside with them.
Brilliant. Okay. Do we have time for, is there one last question that anyone wants to ask? You can ask it live if you prefer. Okay, brilliant. And where can people find you? I know you have Twitter. What's your Twitter handle? Is that the best way for people?
Yeah, or LinkedIn. Either way, under Korin. Yeah, my name is very boring. I think I'm the only one.
Perfect. Okay, we'll link all of that in the information we send everyone afterwards. So thank you so much. And founder, stick around.
I have one last quick question.
Sure.
Go for it.
Awesome. So I was just going to ask how you've been finding selling into startups, because it is great that it's more of a shorter sales cycle, obviously. But one thing that we also always hear is the fact that startups have no money. So how do you get around that?
Well, so the money is, there is a minimum money thing, but even on as long as so for us, you have to be trading for at least 3 months, and either have at least 50K in your cash in your bank account, or 5,000 monthly revenue. So it's kind of a cash or monthly revenue. So you still have to have something to be part of it, not just kind of an idea, but really even someone that has maybe had a bit of money from friends and family and trying to get things started could get it.
All right, we're going to jump into our next session. Thank you so much, Andres, everyone.
Everyone, good luck.
We will post, we'll add Andres's LinkedIn profile to the chat here, so everyone can add Andres. You'll get a lot of invitations, I'm sure. Everyone can add him from there.
Please reach out.
Cool. We are literally going to jump